Hello and welcome. You are watching NDTV Profit. I'm Harsh Saita. With us is Mr. Nilesh Kambli, who is the CFO at Star Health. Results, of course, continue to be in focus, and Star Health's numbers, while not really impressive, sir, talk to us about what's the kind of at least growth glide path that one can expect in FY25 to start off before I come to ratios and start talking more numbers.
Yeah. Good morning and thank you for having me on this show. In terms of growth, we have grown by 18% in quarter one, taking our premium to 3,476 crores. In terms of growth for the full year, we are confident of achieving 18 to 20% growth. All our engines of growth, which is we are naming it as a ABCD, agency, banker, corporate, and digital. All the channels are doing well. There is an improvement in the productivity of agents. We continue to add new agents. We continue to add sales manager stations. In terms of digital business, we have increased our telesales capacity to 2,000 people. We see impressive growth in the fresh business for digital business. In terms of banker, we have 61 plus partners, and we continue to do good business with all the partners, both on the benefit as well as indemnity side. In corporate, we continue to focus on SME and MSME segment. This channel has grown at more than 100% for the quarter. So all across, we see some good growth numbers coming in all the channels. One more thing, we continue to focus on profitable segments. So that is where, in terms of agency, while the growth can be slightly subdued, it is in desired geographies. We are giving up portability business. We are giving up loss-making territories. And this growth is by design, is what we want to say.
Oh, that's very interesting. Let me delve a little bit into that. So what territories are you, or what business are you willing to cede? Where are you seeing loss-making business more? What's the kind of competition you are seeing there? Is it pricing led? Talk to us.
Yeah, so when we talk about giving up loss-making geographies, it is not about competition, but it is about fraud, wastage, and abuse, the cost of hospitalization. We see some nexus between the various elements who continue to claim. Some parts of North, some part of Gujarat is where we see some impacts. We have this data at a pin code level across the country, and these are more targeted decisions depending upon the locations.
Okay, yeah, okay, I take your point. I want to try and shift focus more towards market share. Do you expect that you will continue to retain that 30% plus market share even going forward for the foreseeable future? Or do you think that some of these losses may actually leave you in a place where you are willing to cede market share at an overall level?
So if we look at an overall level, yes, we have given up some market share, but with the kind of growth that we are seeing in the kind of distribution network that we have created, we are confident and we have a strategy in place to grow in line or higher than the market growth rate and continue to improve our market share. The drop in market share that we see is more a temporary phenomenon, and we have plans and strategies to grow it higher.
Understood. And what would those be, if you can give us a flavor of that, and how quickly will they play out?
See, we have given a long-term objective of doubling our business to 30,000 crores, which is an 18% growth rate over the next 4 years. The growth in business will come from agency channel, where we are continue to add 1 lakh agents every year. We have certain productivity improvements that we are seeing in our agent productivity. In terms of digital business, as I spoke, we continue to add telesales workstations. We continue to improve our web sales top line. We continue to add partners to our bank assurance portfolio. We continue to grow our corporate business as well, especially focusing on SME. So these are the channels and the drivers of growth for us.
All right. Let me come to ratios. Before I come to combined, I want to talk a little bit about both your commission ratio as well as your claims ratio. Are you happy with the numbers that have been clocked in Q1 on both these metrics? Do you believe that you can bring that down further? What are the trends that you are seeing which are impacting some of these ratios?
Yeah, so in terms of commission ratio, to look it on a standalone basis will not be a correct number, because these are interlinked. One has to look at the expense ratio, and we have seen a 0.8% drop in our expense ratio, and we continue to do well, continue to enjoy operating leverage as we invest in our cost-saving initiatives, our digital initiatives. When it comes to loss ratio, the loss ratio has increased by 2.2%. We have mentioned in our investor presentation that we continue to invest in preventive healthcare, OPD, wellness channels, which is more a long-term investments. The benefits of it will come over a period of time. We have spent around 0.65% of the loss ratio on this initiatives. What we saw was some increased impact of fever and infectious diseases in the month of May, which is quite uncommon. So we see this as a one-off event, which had an impact of roughly 100 basis points. So if we exclude this, the loss ratio is well within our comfort zone, and this is only quarter one. We have full year to make good some of this excess, which is around 35 crores, and we are confident of achieving our full year guidance.
Understood. And on your overall combined, right, you're now at 99 plus, at least in Q1. There's been a bit of a drag when I'm looking at it year on year. Do you expect to more than make up for this number when I'm looking at it full year FY24 versus FY25?
Absolutely, yes. We have stated that we'll improve the combined ratio by 100 basis points over FY24 for the full year, and we have plans and strategies in place to, to stick to that guidance.
Understood. And the levers, sir, for that?
So the levers we just spoke about, in terms of growing the fresh business, in terms of improving our cost efficiencies, bringing in operating leverage through our digital and tech initiatives, improving our claims efficiency through control on fraud, wastage and abuse, network negotiation of rates, the hospital network negotiation, which continues to be very, very strong for us. The severity of the claims is in line with our expectation and the scale at which we operate. So all these initiatives will ensure that, we maintain our combined ratio guidance.
Understood. You've spoken more about scale. What about, and expense ratios probably coming off, but what about the industry as a whole? What are you seeing on the pricing side of things? Are you expecting to increase prices, hike prices? Is that at all on your mind? We had a large PSU insurer hike prices, of course, general insurance, but hike prices substantially. Do you expect to possibly follow suit, or do you believe that you've hiked enough, which you did do in FY24?
Yeah. See, we see at an industry level the loss ratios have increased, and that's an industry phenomenon as well. When it comes to Star Health, we have always maintained that each and every product will be monitored on an individual basis, and whenever a certain product reaches a threshold loss ratio level, we'll go in for a price increase. We had taken a price increase last year in Family Health Optima, which was steep at 25%. As we see, we have one product where we have already implemented a price increase. We have two more products which will go in for a price increase in the next 1.5 months. So price increase will be a continuous phenomenon. We continue to monitor the loss ratios.
All right, but nothing at the moment in terms of price increase plans.
As I mentioned, one product has already went in for price increase.
Yes.
As we speak, and two more products will go in the next 1.5 months. So,
okay, understood.
So it's an ongoing.
Understood. And how much will that contribute to growth, value versus volume?
Yeah, so if we say around 25 to 30% of the portfolio goes in for a price increase of 10 to 15%, in terms of value, it will add around 3 to 4% on a 12-month basis. For the current year, on a 12-month basis, it will be 3 to 4% value increase. For the current year, it can be around 2.5 to 3%, if we purely look at the impact of price increase.
Understood. And with the expenses of management guidelines kicking through, what are the changes you are seeing at a ground level from an insurance perspective? Of course, you seem to be decently insulated, but your peer group not as much.
Yeah, absolutely. The EOM guidelines kicked off last year, effective 1st April 24. This is the second year, and as per the regulator, they have provided 3-year glide path to some of the insurance companies who are well above the the desired ratios. While we are in the middle of the implementation of these guidelines, we see that some of the peers are under pressure to improve the expense ratios. And while we continue to be comfortable at 31% for a full year, vis-a-vis the allowable expense ratio of 35%, but we see some impact on the players.
All right. So how is that translating? Is that leading to lower competition for you?
See, we'll have to see playing it out. So some of the players are trying to manage it through more corporate business. You know, the group health business comes at a lower expense ratio, but which has an impact on the loss ratio. So things are playing out as we see, but we believe it will benefit a large player like Star Health, you know, who continues to operate at a lower expense ratio.
All right, I take your point. Thank you so much, sir, for speaking with us, giving us all of that perspective on Star Health, and wishing you all the very best for the rest of FY25. Hope that combined falls from 96.7 to 95.7. Of course, we'll chat with you post the Q2 numbers. Thank you so much, sir. Right, with that, it's a wrap. Stay tuned to NDTV Profit. More on the other side.